the business of today. So I've started the recording. I will share the screen. And so we should be seeing the shared screen. And away we go. Okay, today is pretty much the final day for, no, not final day. It's our last class full of new material. Next week, we're going to devote our time to a review. And so I'll be inviting questions from people, and we'll just go over a general chat. And depending on the questions and where that takes us, we'll just see how long it goes. I know I've been working you guys fairly hard over the term, often because of the amount of material that we cover. We've been running over time, so that shouldn't happen next week by any means, especially since you have the exam all ready to go. It's sort of available to you in normal non-COVID situations. Then we would be doing a lot more, fielding a lot more questions about the coming exam or what have you. I mean, we'll be doing that, but we won't be doing it in, I think, the same level of detail that is appropriate when you're doing the face-to-face classes and so on. Okay, this week we're going to be kind of rounding off the topic by looking at dividend policy a bit more and talking about the nature of dividend. Now, in a sense, dividends are what you invest in a company for. You don't invest because of the static value of the company. You invest because of the profits that you're expecting to come out of it, the value, if you like, which in a financial sense is always the present value of the future returns. And so dividends are an important part of that. When you start off doing, whether it's business studies at school or perhaps accounting at university, there's a sort of tendency to think of dividends as just something that, just kind of happen, and to a certain extent they do. If you look in on the ASX, you'll see that dividends are being announced from, fairly regularly. Most companies pay them quite regularly, and that becomes just, the normal expected kind of routine. To the extent that it appears, certainly when you first do like bookkeeping down to profit and loss statements and so on, that dividend is just simply what happens to the net profit. End of story. What we're going to be looking at today is really pulling the curtain back on that and looking at it as a strategic decision. Now, we've talked about this to a certain extent already, but it does put a very different spin on the whole business. I once attended a public lecture by a chap, an Australian man, who had been doing a lot of investigation, if you like, study into the difference between Japanese corporations, like publicly listed companies, and American / Australian companies. America, Britain, the Anglo countries tend to all play by pretty much the same rules. Well, these days, pretty much all of the developed world does. But I think the Anglo world is a bit particular in the way we approach these things. But and I can't remember, unfortunately, this is sort of back around 40 years ago, the name of this chap, but I can remember being fascinated because he tells a story about the way that because of the difference in culture between the Anglo countries and Japan, the attitude between the corporation and the shareholders in particular was very, very different. And I found it quite fascinating. I don't know if you hear so much about it these days, but the normal perspective that we take from an Anglo perspective, say the US kind of corporate perspective, which is pretty much the perspective we're taking with this unit, is that the company is the creature of the shareholders. It comes into existence because a bunch of people get their heads together and decide to start a company. They're called the shareholders and they become directors, and they're simply running it as a public company because, you know, it's too big to be done as a private company, and so on and so forth. And in that case, everyone in the company is very much the agent or the employee of their shareholders, and there's this very strong, almost cultural connection, a relationship which probably is a little bit kind of harkens back to the British kind of notion of master and servant, maybe even the feudal idea of lords and vassals, somewhere in all that. And as a result of that, the interests of the shareholders are pretty much top of the tree, to the extent that, again, in the 1980s, about 40 years ago, Milton Friedman, who at the time was a very influential economist in the United States, basically concluded that the entire purpose of a corporation is the betterment, the benefit of the shareholders. That's the entire quantum, if you like, and that's pretty much what I brought up. You know, what's the purpose of the corporation? Purely to improve the financial situation of the shareholders. When you look at the Japanese situation, it's entirely different, and it's quite, well, to someone with an Anglo background, quite peculiar. And the reason is that the way that the Japanese companies saw themselves was an association of employees going from the mail boy on the, or the sweeper or what have you, right up to the general manager, all as a kind of club, a society, a community. And that association of people had the object of doing whatever. It might be making motor cars or electronics, or might have been the Sonic Corporation. Oh, it doesn't matter. But they saw themselves as the object was to ensure the survival and flourishing of the corporation for the good of the people in it, the managers, the lower managers, the people involved at the workforce and all the rest of it. And in order to survive and flourish, the perception was more that the corporation had obligations to those people who supplied funds, and they basically come down to bankers and shareholders. And so the perspective was the organisation as a community having obligations to bankers and obligations to shareholders, with not a great deal of difference between the two. That whether you're a shareholder or a banker, you're simply somebody who has to be sort of paid out regularly in order to be happy to supply the funds that the corporation needs to operate. And the object of the corporation really is the to flourish in its own right and provide, again, to use a more antique name, a dynasty, a political community almost, an association of persons who have some interest in each other's welfare. And that sort of fed out into all sorts of interesting areas of the way that Japanese companies manage themselves, their organization behavior, management practices, promotion policies, education policy, all sorts of things. Absolutely fascinating. Okay, why am I talking about this today? The reason is that the idea of dividend and dividend policy kind of sits across this question. are corporations most appropriately thought of in the Anglo framework, which is the corporation has an obligation to their shareholders, and therefore, it's very much simply an agent for the shareholders? Or is it an independent entity that has obligations to the shareholders, and as long as you fulfill those obligations adequately, get them off your back basically, the corporation is able to just go along and do whatever it is that it wants to do? Employ people, build things, grow, all that stuff. Okay, and it's a very hard decision or distinction to make. And so the topic today, and it's a really nice topic to really finish off our exploration of managerial finance, or business finance, if you like, because it sort of pretty much closes us back to what we started with. We started off by looking at the different forms of corporation, of firm, and now we're coming back and really, putting the icing on the cake, okay? Because dividends is what it's about. Now, from that perspective, dividend is not simply something that automatically happens with your net profit after you've paid taxes, after you've met your obligations to the bankers and all the rest of it. It's something that you structure as a way of returning to the owners what the corporation has produced using the resources that have become available as a result of the owners contributing capital. Okay, so the owners put in their money, they turn that into capital by buying factories and machines and computers and whatnot. They operate their business and it generates wealth. I like to avoid using the expression creates wealth, because when you unpack that a little bit, you find that the corporation produces wealth. It doesn't create it. It's a distinction perhaps for another time. But one way or another, wealth is being produced. And so at the end of the year, you might start off with $1 million or $100 million in capital in a company, and that $100 million might go up to $105 or $110 million. In one sense, the owners of the company, shareholders, begin the year, let's say they've got 100 million shares, each worth $1 each. At the end of the year, they've got 100 million shares, now worth 105, in total worth 105 or 110. Let's go with 105 million dollars amongst 100 million shares means that they're worth $1.05 each. Okay, hopefully they do a bit better than that. And that's all that really needs to happen. We don't need to pay dividends. What a dividend does is really return to the shareholders a bit of that excess. Doesn't have to. In a sense, the shareholders could go and sell their shares, and that way they would realise their 5% profit, and they don't really need a dividend. So whether the dividend is paid as a cheque for 5 cents for every share that you own, or it simply comes from the fact that you can sell the share for more than you bought it for, it actually makes no difference at all. From the company's point of view, they have to decide what level of dividend to pay to meet a number of strategic objectives. Let's just look through what the slides have got to tell us about this process. What we're saying in these first couple of slides is basically what I've been outlining so far, that a dividend is something that the managers of the company do consciously. They don't simply pay out all of the net profit of the company as dividends, because they're going to decide what dividends they're going to pay. If they don't pay any dividends at all, the value of the company internally goes up, and that has the advantage for the company that it often can provide the resources the company needs in order to do expansion and things like that, which again is a great benefit for the for the shareholders ultimately. So this question of how much we distribute kind of is pretty much the basis. It doesn't have to be all, doesn't even have to be part. It might benefit the company on particular occasions not to pay a dividend, or at least to pay less dividend than it expects, because, and we've met this module or two back, where we've realised or recognised that retained earnings is a good way of funding expansion. So what considerations do we look at? Okay, and that sort of covers these first two slides. Okay, we need to consider what possibilities there are for dividends. And the probably two basic characteristics, or two basic options. One is an actual payment, and the other is some kind of rearrangement of the shareholding in the company, either by offering bonus shares or some other thing like that. It can be by a share buyback, which kind of does pretty much the opposite. Or it can be, and so we've got changing the shareholding arrangements, or simply paying cash. When we look at the paying cash option, we can either be looking at a regular expected, it's this part of the year, and every year the company pays a dividend, so I'm expecting, regardless of which month of the year it is, I'm expecting the company that I've owned shares in for a while, or I've sort of studied and I've only just bought it or what have you, I'm expecting that company to pay a dividend, whether it's January or October, it doesn't really matter, because that's what the company does every year. In addition to that, there are special dividends, which is a one-off, if you like, bonus payment, which kind of comes out of the company, very much as a result of the decisions of the management, board of directors. But they're basically the same thing. One of the curious things about it, and we'll go back to our original example, the $100 million becomes $105 million. What are they going to do with this $5 million? Do they distribute it all? Do they distribute part of it? What's it going to do to the share price? We've said that if there's no dividend distributed, the share price is simply going to go up to probably pretty close to the $5. A shareholder could sell maybe 5% of his shares and get the same effect as a check in the mail. However, he ends up owning 5% less shares, and from that point of view loses a little bit of the percentage involvement in the company that they had previously, or the company can pay a dividend. The dividend doesn't affect the balance of ownership in the company, therefore the balance of influence. This is something which is particularly important for larger shareholders and so on. And so in a sense, the dividend has the advantage in some ways from the shareholders' point of view, some shareholders, probably not so much from the company. There's an aspect of taxation with dividends, that the dividend is the formal recognition that wealth from the company is being distributed in a kind of one-way system, one-way sense to the shareholders, and so there will be tax. One way or another, even if the dividends aren't distributed, the company is still going to be registering a profit, and the company will still be paying tax. But if all of the net profit was taxed and then is distributed as dividends, then it's a bit more transparent how this tax situation kind of affects the whole thing. We said right at the very outset that companies are legal persons. And so if legal persons, you and me, get to pay income tax, then companies as legal persons also get to pay income tax. And that's pretty much the way that it operates. Up until 1987, that's exactly what happened. Very, very simply. A company made tax, it paid tax, admittedly it paid at a different rate or on different scales to personal income tax. And so you have company tax rates, which tend to be fixed, as opposed to personal income tax, which tends to follow the progressive scheme. But up until 1987, we had what we call classical tax system. And there was a lot of debate in the late 80s because it was considered that, unlike individuals, I mean, if I do something and pay income tax, what I've got left afterward, I tend to spend on myself or my family, and so it goes to my standard of living. Companies don't need to maintain a cost of living. Companies just aren't that sort of a person. Companies only exist to make some sort of produce wealth for other people, and it's the other people that actually get to distribute it. And if you give some thought to what income tax is all about, in a sense it's linked up with this idea of sharing with the government out of our personal product that one way or another we would have otherwise used for our own enjoyment. Companies don't enjoy, so that kind of analogy sort of breaks down with that particular legal person. Why am I sort of talking about this? Because the classical tax system, just simply applying the income tax logic to companies, wasn't a very good fit, because to the extent that income tax, in a sense, is indirectly linked to our standard of living and cost of consumption, stuff like that. Companies don't have that. When a person owns a share, they only own that share so that they can increase their income and live at a better standard of living. If I earned my income through my own efforts, I would pay tax and then I'd go out and enjoy the rest. If I earned income through a company earning some kind of a profit, the problem there is that the company would pay the tax, 30 cents in the dollar, and then I would get, for every dollar that the company made in profit, only 70 cents. I would be seen as earning 70 cents, and I might have a marginal tax rate of 40 cents in the dollar or something. And so out of that 70 cents, I might pay 40% of that. And so by the time the dollar of profit that was in the company actually gets into my pocket to be able to spend it, I could easily have less than 50 cents in my pocket. Okay. And so in the 80s, there was a lot of criticism of that. What replaced the classical tax system? I don't even know if classical is a good explanation for this. The earlier system, we'll call it. I don't think it's classical in any sense of the term. I think I might have mentioned to the class that the idea of income tax is only a relatively recent phenomenon. It was suggested in the mid-1800s by a rather curious fellow who normally isn't considered very highly in Western finance circles. His name was Karl Marx, and he saw income tax as a way of fostering the communist revolution. So if you think of yourselves as closet socialists or what have you, then you can get excited about income tax. But for the rest of us, income tax has a lot of peculiarities. Okay. In 1987, company tax system was changed to a system which is now known as the tax imputation system. And the tax imputation system is a more elaborate system, but it's intended to result in income tax only being paid once between where the income, the wealth, has been produced and where it gets consumed. So it gets produced in the company, gets consumed by the individual investor. And so the tax imputation system is a way of avoiding this double taxation system. The way it works is very, very simply that when a company pays its income tax and then gives the dividend to the shareholder gets a credit against their income tax obligations equal to what the company has already paid, called the tax imputation system, and you'll find a lot of references to things like franked dividends when we're talking about this. It's a way of indirectly ensuring that tax is only paid once. It does work out a more complicated approach to paying tax. The reason is that individuals pay different levels of tax, and so you can't simply give one exemption or what have you to all shareholders, because some shareholders will pay a lot of tax, some will pay a little bit of tax, some may not pay tax at all. And so the tax imputation system has this kind of level of complexity. We'll just explain how it works. And this diagram, I think, is one of the best explanations for the tax imputation system that I've seen. Quite simple, but it gives you an idea of what can be conceptually a perhaps even unnecessarily complicated arrangement. Okay, let's look at our example. A company earns $100 in profit, makes $100 worth in profit after it deducts all of its expenses, takes out its interest payments and all the rest of it. At the point where it's about to pay tax, it's earned $100. The company tax rate is 30%, and so that means out of that $100, $30 is paid to the government. Tax is paid, done. It leaves $70 in the company available to be paid to the shareholders as dividends. Whether the company pays those dividends or not is a decision for the company, but one way or it's available. But what it means is that for every $70 in the company, it represents a prepaid tax of $30. And how does that work? Well, the company's got the $70 in its coffers, in its bank account. It may pay you, let's say, $70 of dividend. You go off happy. You've got $70 that you can go and spend. Now, the problem is that's $70 worth of income, and you're being charged income tax. And so out of that $70, you might have to pay, and in this case, we'll look at the marginal tax rate of 45 cents in the dollar. And so out of that $70, you're perhaps lining up to pay a another 45%, which would be something like another 31 cents. Okay, if that was all that was going to happen, what it would mean is that out of that $100 worth of income earned by the company would pay $30 in tax. You'd then pay another $31 in tax, which means that you'd actually get to spend only 39 cents, roughly a little bit more than a third. Okay, but this is where the trick with tax imputation comes in. The $70 you get in your pocket, in the mail, in your dividend check, comes along and it says this dividend of $70 actually includes prepaid tax of $30. And so the $70 can be grossed up. It can be returned, if you like, through the magic of accounting, back to the original pre-tax amount, and that's the $100. And so even though you only get $70 in physical check, for taxation purposes, you're considered to have earned 100. But as well as that, you're also considered to have prepaid, if you like, $30 in tax. So now we look at the $100. The $100 somehow has reappeared. You go along to your accountant to have your tax done. The accountant works out that even though you've got a check for $70, you've really got $70 plus $30 worth of prepaid tax. So your income is $100. You should be paying 45 cents in the dollar on that $100. And so that would normally mean you've got an obligation of $45 to pay the government. But the government says, oh, yeah, okay, you've got to pay $45. However, $30 of that 45 has already been paid. And so you only need to pay $15. What that means is that out of your $70, you only pay 15 cents for every in your 70, which is, if you like, in your hands, the cash is being paid at a rate of about 21 cents in the dollar. So if I go out and work hard doing my job, whatever it is, trade, profession, what have you, I'll be paying 45 cents for every dollar of income I get. But in terms of the tax I have to pay on my franked dividends, I only have to pay $15 for every 70, at least for this case, and that works out to be a net payment of about 21 cents in the dollar, 21% tax, and so my tax obligations on my franked dividends is somewhat less. The overall result is that I do pay the true 45 cents in the dollar, so nobody's ending up better off, but it does mean that the problem of double taxation is avoided. If you get your head around the way that the tax imputation system works, then that's fantastic. When you see it, when it makes sense to you, you'll find that it's a very, very simple system, and it does ensure that kind of equity. Further on down the track, you might want to ask yourself, is that equity totally equitable for the community? And that's a topic for another day that we don't really have time for. However, yes, sir.
Yes, so if there is class taxation, is how it's going.
Say again.
The classical taxation is how it works.
Oh no, the classical approach went out in 1987, so it hasn't been operating now for 40-something years, no, 30-something years, 33 years. Okay, so you don't really have to worry about encountering that in practice today, because company dividends come with tax imputation. So when you get a dividend, you get it franked.
Thank you.
Okay. Yep. Yeah. It's more a historical novelty. For those of you who want to take this further, and I do recommend that, especially more thoughtful in the class, may want to give this some thought. The whole question of tax is a social or a political problem, not social in the socialist sense, but social to the extent that human beings are social creatures. We're part of a society, and sort of questions of how the government, how the community raises funds to do the things it does, whether it's provide health and law and order and infrastructure and all the things that the government sort of produces for us. How that's a topic in itself. So it's a big topic. This is only a very, very tiny little part of it. But this idea of double taxation, the idea of whether we're being entirely consistent, creating on one hand a legal person, but on the other hand not treating it as a legal person, whether there's an inconsistency there. There are other kind of anomalies that you find in the taxation treatment. The other week when we were looking at more at the use of debt, the way that interest payments are a tax deduction is also part of this bigger question to do with the ethical, perhaps, maybe social merits of the way that we treat banks and so on. You know, why is it that the bank interest should be a tax deduction? All we can say is that it's always been one, you know, or at least it has for as far as I'm aware. But should it be? Very debatable. Is the classical system better or worse? Yes, sure enough, it appears to double tax those people who are in a position to own shares. But there may be an argument to say that since we're looking at the situation of those people who have got money they don't really need, then maybe taxing it at a heavier rate may not be such a bad thing. Now, I don't want to get into those arguments because people will get very excited on either one side of that question or the other. But I do invite you to think about it as you go through life, because simply coming down and saying, yes, it is, or no, it's not, is a very simplistic view, you know, and one that an educated person should explore a little bit deeper. And, you know, while in the way that that's often done in our world today, it means that we're looking at what I consider to be very blunt, almost brutal divisions in terms of the way that people can approach this bigger question of economics. You know, are you a capitalist or are you a communist, basically? I might have a preference for capitalism. Yep, that's fine. Some other people might have a preference for socialism, which is the softer name for communism. Maybe that has some merits. An educated person is be able to say, well, this approach has certain merits, but also has some disadvantages. This other approach has certain merits and it has disadvantages. To simply come down and say, hey, you know, I've always voted for the Liberal Party, therefore the Labor Party stinks, you know, not very wise. Vice versa, someone who comes along and says, you know, Labor or nothing, and, you know, anyone who votes for Liberal should be sort of hung at dawn, which you find occasionally. You know, likewise, it's a fairly simplistic approach. With this question with tax is extraordinarily important because it has the capacity, one way or another, to introduce all sorts of distortions, which aren't always obvious. And I think it's very important that people are rewarded in proportion to their effort in their contributions to an economy. That's an ethical position, if you like. I think it's also an advantage to have an economic system which discourages excessive polarization of wealth. Moderate polarization of wealth, I think, is very important and natural. There are some people that work harder and some people who prefer to put their feet up. Obviously, the people that work harder should be rewarded for their harder work. I used to work with a chap, he was an engineer. He escaped from Czechoslovakia way back. And he was saying how, as an engineer, his income was the same as if he was a hairdresser. And I said, well, why do you have engineers in Czechoslovakia? This is back in the communist days. And he said, oh, well, I just like the idea. And I thought, yeah, okay. Well, but, you know, being a hairdresser would be an awful lot easier, wouldn't it? You know, you don't have to go study nearly as much, you don't have to take as much responsibility. So there are those kind of issues. On the other hand, if you get to a country, say like Mexico, where there are extremely wealthy people and there are extremely poor people, and most of the people are extremely poor, and they're hardly able to live in any sort of way which is consistent with human dignity. That's where this idea of differential payments kind of, you can see, has gone too far. So in Czechoslovakia, there's probably not enough differentiation, or wasn't back, you know, in the times when my friend left the place, wasn't enough recognition of differential effort and differential reward. On the other hand, places like Mexico and a number of other less developed countries. You know, the extreme had gone too far the other way, where the people that had what they didn't need and would used what they didn't need to get even more of what they don't need, to the point where they had an absolute huge amount of stuff, whereas the average Mexican is, you know, hard to keep body and soul alive. You know, you can see that these sort of abuses in either direction. Okay, we're not going to go too far down that track. It's just good to be aware that when we're studying finance, we're studying something which is got to do with the mechanics of issues which are very, very close to these issues. Okay, and whether tax imputation is a good thing or a bad thing, in a sense, it has resonances, it has implications for these bigger and deeper issues. And so understand tax imputation, and that will help you if those of you who want to go off and maybe get involved in politics or social reform or whatever it is you want to get involved with, may want to think about these things in greater depth. I would warn you, though, generally, that if you do take an interest in this, and I think for young people, it's an extremely useful thing to do, don't rush into taking a position too quickly. Okay, I know some people that will only ever read what they call conservative authors, and they just think anybody who's not like them is a rabid, dreadful communist. They've taken a very simplistic view. I know other people that you know, think that anybody who is you know, not sort of totally head over heels in love with the idea of social reform and socialist reform and, you know, all that sort of carry on is in somehow a traitor to the people and all that sort of carry on. Both positions are, I think, problematic because they don't come to grips with the complexities involved. And the fact that these answers, the questions to these things have got to do with balancing conflicting values and finding a practical balance in the middle rather than sort of something one pole or the other. Okay, better not go down too far down that track. We better get back and talk about dividends. Okay, let's look at the dividend payment process. Very, very simply. Okay, a company board of directors make a decision, an observation. Maybe they have their accounts kind of come in, they discover they've got some extra wealth that's been produced in the company, and the board of directors decide to make a dividend payment. Now, does that mean that it just kind of comes out of the blue and each dividend payment is somehow a surprise, a novelty, an unexpected bonus? No. Generally, you expect the company to expect these things and be working towards it sort of all year. But one way or another, it is when the board of directors votes for a dividend payment. It will then make a public announcement. Now, just think in terms of what's going to happen here, right? You've got your shares. Little by little, the community is kind of seeing that the company is working hard and maybe successfully, or whatever it's doing. And the share prices will tend to be sort of coming up little by little through the year as the community recognizes that the company has got more in it. Because the company, you know, obviously if it's trading well and all the rest of it, week by week, month by month, the company has got more value inside the company. And so that's reflected in the share price. And so you may find that the company comes along and it's got a share price of, let's say, $1.05. The board of directors then decides to vote, and they say, "Oh, okay, well, our share price is now a bit higher than we really need it to be. There's sort of, you know, money being put into the in the company because of its effective trading. Da 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 da. We're going to pay a dividend of 5 cents in the dollar to all of our shareholders, 5 cents per share." That effectively sends a signal out to the market. And a lot of the thinking in terms of dividend policy and so on is all about almost psychology, about signals being sent, about confidence, insecurity, optimism, pessimism. These are psychological terms. Okay, the board votes. It recognises that the company has got money that can distribute. The market will tend to price that, so the share price will be high, let's say $1.05. The company will, the board will then tell the world. It will make a decision. Shortly after, it will tell the world, and it will say, we are going to pay a dividend of 5 cents in the dollar. Now, if you think through the logic of this just a little tiny bit, what should be obvious is that if the company has got wealth in itself sufficient to support a share price of $1.05, and the company decides to pay 5 cents to all of its shareholders, that means that the company is losing that 5 cents worth of value per share, which means that before the dividend is paid, the shares will be worth $1.05 because they've got this 5 cents lurking inside them. After the dividend is paid, the share price will come back down by the 5 cents. If we had fully informed, rational markets, that's exactly what would happen. The greatest lie that you'll ever be told in your life is what you get told in economics classes, that human beings are rational, self-interested individuals. That's the way we start our economics classes. Humans are kind of almost rational. They're certainly not fully rational. Some people would say. Anyway, I won't go there. What's going to happen? Once the public announcement is made, then the community is saying, oh, okay, these shares, I'm very happy that they're worth $1.05. But after the company has paid out this money, they will have lost that extra 5 cents. And so the share price should come back down to the dollar that we started with. Okay. So we're going to have a public announcement. Everyone knows what's going to happen. Pretty important to put dates on it because people want to rush in and buy the shares before the dividends are actually paid. And that way they're buying a share that they know that shortly they're going to get a check in the mail for. Okay, so what are you going to pay if you know that someone's going to pay you an extra $10? It's like cash back when you buy some, I don't know, new phone or something, and someone says, oh, well, you buy it from, such and such a retailer or what have you, and the company's going to give you a cash back. In a sense, you're willing to then pay more for that thing, whether it's a new phone or a share. Okay, and so the public announcement is very, very important because in a sense it flags to the world that there's going to be a payment of so much. There's going to be a check in the mail for every share that you own. The price of the company share often changes when the dividend is announced. And I've sort of talked about this, it sends signals to the market. And it also confirms in the community's mind the strength of the company. And so if this time last year, the company paid 5 cents in the dollar, and this year it's going to be paying another 5 cents, and it's been doing that for, since the cows come home. Then the community is likely to be more confident, more secure in owning those shares. And so the more secure it is, the better the share price is likely to be. Again, these psychological terms we keep sort of bumping into, and it all got to do with signaling. Okay. Then, next thing is that because of the complexities of keeping track of who the shareholders are, and the fact that people are going to be buying and selling shares pretty much continuously, a moment in time has to be set where you're either trading a share which is going to receive a dividend or one on which the dividend's already been paid. And that's referred to as, that moment in time is referred to as the ex-dividend date. And that merely means that today the company has announced that it's going to be paying a 5 cent dividend. And so somebody who owns the share today is going to get 5 cents in the mail for every share they own. However, at some point, usually pretty close to when the dividend's paid, it will get to the point where even though I might sell you my share that's worth 5 cents to me, It's so close, you know, from a practical bookkeeping point of view, that I might sell it to you, but the check's already in the mail to me for the 5 cents, right? And so you know you're buying the share, and the dividend's going to come to me. It's not going to come to you. How much are you going to be willing to pay for that share? Well, obviously, you were going to pay $1.05. You know I'm going to get this 5 cents in the mail. You're not. And so you're going to go around with perhaps your nose out of joint a little bit and say, oh, well, that share's not really worth $1.05. It's only worth $1 because Small's going to keep that 5 cents, isn't he? Okay. Now, to keep things a little bit organised, the share trading process sets the date where that change happens. Before the date, the old owner gets the dividend, but when they sell it, the new owner inherits the dividend as well. After that magic date, the ex-dividend date, then the dividend still comes to the potentially former shareholder. Okay, and it's kind of fair, right? And so the ex-dividend date is very important, and it's kind of described there on the slide. It simply means that a date is set, and so the market can then price what it sells for, and you expect, at that moment in time, the share price is going to change. It's going to change by pretty close to the value of the dividend. Okay. The practicalities are a little tiny bit more complicated than that. We've introduced the idea of the board has made its decision. It's made the announcement. It's set an ex-dividend date. There is also what's known as a record date. And this usually is set 2 days after the ex-dividend date. And the reason is it's just a time to have the dust settle on any trading. So the record date is to say, well, okay, a share may have traded on the, just before the ex-dividend date, but because of just the time it takes to actually get that into the company records so that the company is able to send the check to the right person, then we're going to set the record date. Record date, as I say, usually it's a couple of days after the ex-dividend date. The last date is the most important one in some ways. It's the date when the actual payment is made. Okay, so I've got a number of dates, and that's sort of shown on this diagram. And the diagrams often are a nice way of understanding all this stuff. Okay, so what happens? On one date, the board takes a vote, has a meeting, votes to pay a dividend. Very shortly after, the board makes a public announcement. That's the declaration date. So that says, yes, the board of directors has recognised that we've got this nice, handsome profit, and we're going to distribute that in the form of a dividend. At this point, they will announce the ex-dividend date, which is the threshold date for whether, when you buy the share, you either buy it with the dividend available or not. 2 days after that is where the records are finalised on who actually owns the dividends, who bought it before the ex-dividend date, basically. And then once the record date is passed, the company then knows who gets the dividends. And so a little while after that, the payment is actually made. So between the board vote and the payment date, there are a number of landmarks that you've got to follow. Okay. Not too complicated. But it takes account of the practicalities of the human systems that are involved. Okay. Yeah, well now, actually, it's probably now is a good time to take a break. It's 2 o'clock, lovely time to take a break. We've gone through the mechanics, if you like, of dividends, and we'll come back after the break looking at an alternate way of sharing out, distributing the excess wealth of the company in terms of buybacks and so on. So we'll take a break now. It's 2 o'clock, so at 2:10 we will meet again. I will stop the share, pause the share, and we will. Okay, now we come to an alternate way of distributing the wealth out of the company, and that's by doing something with the shares. The most straightforward is to buy them back. And so if we've got the 100 million shares out, and they're all worth $1.05 now, if we buy back, let's say about 5% of them, somehow in proportion to the ownership, then we're actually paying into the community that extra money. We're going to buy back, so say, $5 million worth of them. And so we go into the community, we basically put that, we take money out of our coffers, we put it in the community, and basically we're retiring some shares, shareholders benefit. Kind of has the advantage to a certain extent that it keeps the share price up. And so it's a kind of a discreet way of distributing the wealth of the company. Okay, I'll let you read through the slides. I mentioned earlier that shareholders tend to be very cautious about losing control of the company. And so if I sell back to the company half of the shares I own, then in a sense I also give away half of my voting rights for the next general election and so on. So often the share buyback will be on some kind of a proportional or a pro rata distribution. It effectively, the share buyback kind of distributes the funds simply by removing shares from circulation. So it kind of concentrates to a certain extent the ownership of the company, depending on how that is done. The tax arrangements are very different between a share buyback and dividends. We've already gone through the complications of the tax imputation system. But the share buyback is treated quite differently, and it's kind of outside our scope to talk about that in great detail, but you can read about it if you like. And also, in terms of dividend or difference from dividends, in one case, we're not really changing the balance sheet, we're simply distributing a profit. In the other case, we are potentially at least reducing the shareholding in the company. And so that can have effects on your balance sheet and also the way that your creditors will perceive you. And so there is like these management, like strategic financial issues that sort of come as a result of doing a share buyback. There are a number of different strategies for doing share buybacks. You can look at those and read about them in detail. The important thing for our purposes is to know that there are different ways of doing it. They're not all the same. I find point 4 here is interesting because it recognises that often employees of a company can be significant shareholders, not significant as in majority shareholders necessarily, but they can represent a fairly significant part. And there are often employee incentive schemes which consist of giving employees shares in the company, maybe as a bonus or maybe because of their particular role in the company, whatever. And so that also has an effect on the whole dynamics of the company. There's a curious actually set of companies called Mondragon in Spain. And the Mondragon Industries, and they cover everything from shopping centres to banking to advanced electronics and engineering. The shares are just about exclusively owned by the employees. So it's worth looking into that. Okay. Out of the different methods of buying back shares, on-market share buybacks are simply the most common. And while there is a certain amount of regulation that sort of limits how much of the shares a company can buy back, they tend to be minimal and probably give the company the most flexibility. However, to avoid distortions in the market, it's often prudent, usually it's prudent, for companies to only do the buyback very gently. And so the buyback can take, months to complete. Dividend policy and benefits and costs. I think we've already done a fair bit of this. Really, in a previous module, when we were looking at capital structure and the M&M propositions, you'll recall that we were talking about these propositions and the general point that the capital structure is unaffected, like the value of the company is unaffected by the capital structure. It's the same thing here, because dividend policy ultimately has the potential to change your capital structure. Is it going to be an effect or not? It is partly dependent on how important tax is, because the different ways of paying a dividend or not paying a dividend, or distributing the wealth or what have you, has to do with the way that tax is worked. So it's a fairly specialised area and beyond our introductory level here. We'll look at the benefits of dividends. I'll let you read through those, and it's just a matter of kind of working through the slides. And I think we've talked about most of these benefits already. I mean, obviously, the shareholders benefit from the dividends, but it's a matter of whether that's an efficient way of sharing the benefits of the company running with the owners. You also have to consider the different types of shareholders. Some shareholders, let's say somebody who is relying on those shares for their, normal cost of living, especially say sort of people on fixed incomes, retirees, investors, and so on, they will have a different attitude to dividends compared to somebody who maybe is younger. If you're in your 20s and you're thinking about maybe doing something with extra funds that you've got, or maybe an inheritance that you've earned or what have you, and you think, oh, I'll buy shares. That's terrific. Well, because of your situation, you're probably thinking in terms of, well, these shares are a good thing because they're going to be a part of my retirement off in 40 years' time or something. Do you want dividends today, or would you prefer the shares to grow in value? For younger people investing, especially when it's not your primary form of income, then you prefer the long-term capital growth that comes from companies reinvesting their profits compared to a dividend being distributed, because in fact, in the short term, the dividend might be a positive disadvantage for you because it may not suit your tax situation. And so you have to consider those things, and the company has to consider those things when it's considering its dividend policy. I think we've already mentioned most of the items that are on there, and you can read through those in your own time. Let's look at the costs. There is a certain amount of cost involved in organising a dividend, obviously just the administrative cost and so on. There's a certain amount of regulatory provisions that has to be met, so there are also costs. And there are more complex methods, and especially the dividend reinvestment program. And it's a way that a company sells new shares to the dividend recipients, who basically reinvest their dividends in the company's shares. And so while it's increasing the number of shares, it doesn't actually involve the company losing any cash. And this is something we're going to be getting to shortly. Before we do that, need to do this file. read through this. The cash flow identity equation is one of those delightfully straightforward equations which is very useful as a conceptual tool. Remember we talked about the accounting equation sort of a few weeks ago? Assets equals debt plus liability, debt plus equity. Here the cash flow identity equation is similar, and let's break it up. The cash flow from operations, kind of cash flow profits if you like, added to the equity and the debt, those three things always equal the dividends plus interest payments plus principal plus investments. Investments is funds being rolled into the company to expand it. Principal is repayment of loans. Interest is, well, interest payments on loans, and dividends is those payments to the shareholders. So one way or another, your cash flow plus equity and debt is going to be equal to the right-hand side here, and that's kind of laid out on the slide. The next couple of slides, next few slides, are simply a couple of worked examples. I won't go through this. It's as easy as adding up these slides, these examples, simply taking this and saying, how about if I know all of these except for one, and let's work it out. And it's just simply a matter of adding and subtracting. Okay, let's look here. A company is trying to do some financial planning for the coming year. The company plans to raise $10,000 in new equity this year, wants to pay a dividend to shareholders, $30,000 in total. The company must pay $20,000 interest for the year and also pay down principal and debt obligations to $10,000. Let's just go back to our previous slide here, and we'll see what we're doing here is basically putting numbers on the four items here on the right-hand side. Okay. If the company continues with its capital budgeting plan, it will require $100,000 for capital expenditures during the year. Okay, that's the investment part. Given the above, how much cash must be provided from operations for the company to meet its plan? And it's simply a matter then of evaluating the equation, cash flow identity equation, and we've got basically all the numbers except for cash flow from operations. And there you have it. Okay, I'll let you work through that in your own time. Another example, same thing, but here it's asking a different question, and basically just rearranging the equation. So I was looking at solving for the investments in time t, and simply by putting in the values which are listed in the previous slide for all of those to solve for that. Again, addition and subtraction, kind of useful as a conceptual tool, and I'll let you practice that in your own time. I don't think we need to dally with it right at the moment. Okay. I think we've already talked about this. There's a certain amount of psychology I mentioned, which we need to give some thought to. Comparing dividends to share buybacks. We've already talked about the advantages and disadvantages, so I think we're kind of going over similar ground, but maybe putting a little bit more detail into that. Yeah, just read through those. I think we're going to find a similar thing here. And the agency issue, I think, sort of comes out to a certain extent. You know, you can see that this is partly to do with strategy. We've got a bit to do with taxation, of course, because the complexities of the way that tax is treated for dividends as opposed to maybe share buyback and so on. And there is that agency issue kind of lurking in there. Okay. Again, we can just read through those in your own time. Agency issues. Now I want to look at a couple of other approaches to manipulating your equity, your shares, as a way of distributing the company's wealth. We've looked at buying back the shares. That's, in a sense, a very gross way of adjusting your shareholdings to reflect the extra wealth in the company. I mean, to a certain extent, if the company was to, I mean, if it was allowed to, if it was to continue to buy back its shares, it would eventually get to the stage where, you know, potentially it could have bought back virtually all of its shares. It could basically just be sitting there with no shareholders at all, perhaps, or maybe just one or two or something. It would be kind of a weird situation. So we tend to avoid that. But there are other ways of using shareholdings as a way of distributing dividends. The bonus share issue is probably I think the best example of it. A bonus share issue is where I might own, you know, 100 shares, and the company says, well, we're going to award bonus shares at the rate of 1 bonus share for every 20 shares that a shareholder owns. And so what that means is that I might start off with my 100 shares. I'm getting offered bonus shares at the rate of 1 in 20. And so it means that my 100 shares then, I'm going to get share certificates recognised, which will give me another 5 shares. What's that going to do to the value of the company? Well, it's not going to do anything at all. The company is still sitting there with its undistributed profit. Previously, let's take our original example, 100 million shares. Company is now worth 105 million. Okay. The company's got the 105 million in capital. It was thinking of making a 5% dividend, a 5 cents in the per share dividend. Instead, they're going to be issuing another 5% more shares in some kind of ratio to the existing owners. The company now doesn't have to distribute any of its wealth. Internally, it's still paying its tax and so on, still earning a profit. But from the shareholder's point of view, today I own 100 shares. When this bonus share issue actually matures, I'm going to own 105 shares. Now, notionally, that gives me the flexibility to say, well, I might want some income. I could sell those 5 shares. People do that. Alternatively, I could say, I'd like to keep those because I'm, you know, saving for my retirement and preparing for the longer term and all the rest of it. And so I simply keep the 105 shares. And I hope that they do a bonus issue next year as well. Eventually, I'm going to own a lot more shares. And so my retirement's going to be a lot more comfortable. That's a far more comfortable way than actually having this cash kind of come to me that I don't really need or want. So the bonus share issue has a number of advantages. It means that the management of the company make available to the shareholders something which is virtually as convenient as a check in the mail. Not quite as convenient, because to sell the bonus shares, they're still going to have to go through brokerage fees and go through the market and all that sort of carry on. So it's not quite as liquid, but almost. It also means that the shareholders have the flexibility then to be able to use those shares for either immediate income or long-term kind of growth in their investment. And so you don't have the problem then that you have when a company declares a dividend, because the retirees who are relying on the dividends for putting beans on the table are happy, but the young people that are saving up for their retirement in 40 years are unhappy. With the bonus share arrangement, both are equally comfortable. So the company benefits, by not having to alienate its wealth. The shareholders, the different types of shareholders also benefit. So a bonus share issue is not uncommon, and it's very, very effective because it meets the needs of most of the people involved. So it has a lot of advantages. There's also a strategy known as a share split. Now, share split is kind of curious. It is similar to a bonus share, but what it means is that for every share you own, it's not simply a proportion of extra shares that you get, like the 5% increase or what have you. It is usually done by splitting each share you have into multiple shares. So I might have my 100 shares, and the company might announce a share split of 5-to-1. And so instead of having 100 shares worth $1.05, I would end up having 500 shares, probably worth 21 cents each. If you do the maths there, you'll find that I still own the same amount. What's the advantage of doing a share split? Well, the advantage really comes back to the flexibility for the shareholders. By suddenly having 500 shares, it gives me a lot more flexibility with how I distribute my shares. Let's imagine if I only had one share and it was worth, $10,000 or something. I either sell it or I keep it. So how flexible is my use of my investment funds? Not really. I either sell it or I keep it. Whereas if I've got 500 shares worth the same amount in total, then I might sell 100 of those shares or 200 of those shares or 50 of those shares. Conceivably, I might sell one of them. I don't think anyone would, but conceivably you could. And so it gives me a lot of flexibility. And so a share split, while notionally it splits not just the number of shares, but it also splits the value of those shares. It also produces a lot of flexibility. So that is kind of one of the advantages of share splits. Not something that a company would do every year. Okay, I think these PowerPoints just give us some background to that, and you can read through those. It just basically goes through the way that the share split works. And again, I don't think it needs to be written out in, or as I sort of spoken about in detail. It speaks for itself. Okay, reasons for bonus shares and share splits. I've already gone over most of the advantages of those. I'd like, though, just to focus as well on what it does for the community, what it does for perception. I mentioned earlier that the psychology, if you like, the psychology of the market is an important consideration with all of these things. That one way or another, the rational market may not be reflected in the actual market. And we see this to a certain extent, when something good happens, or even when something bad happens, the market will often react in a way which is considerably extreme, considering the actual changes in the marketplace. It seems that the world is now so geared that the announcement of a American presidential election, or something like that, or the contenders even, or the outcome of an election even more so, will cause the share market to either go up or down. Now, the fact that I don't know, Mr. Trump sort of keeps his seat, or Mr. Biden sort of comes in and does whatever he's going to do, does that actually sort of change business immediately? Well, very unlikely. And in fact, both of those men will know that the last thing they really want to do is so disturb things, regardless of what their policy differences might be. They don't want to disturb things so that the normal operation of business and people's employment and you know, the activity of actually sort of making, you know, bread, milk and meat available on the shelves. You don't want to disturb that. I mean, politically, it's kind of a pretty silly thing. However, the share markets will react to it. They react to it without evidence of changes in cash flows or what have you. There's a lot of psychology in the way that the market operates. Ultimately, it tends to come back to some kind of, you know, quasi-mathematical precision in terms of, you know, price-earnings ratios and capital asset pricing models and all those things. But there's a lot of wobbling around in the middle. Okay, so the importance of a company being perceived to be going well is extremely important, which is really the point here. And signaling into the market is important. A company might have a good year, that's fine. They might want to capitalize that by telling the world. Alternatively, they might say, well, we've had a good year, we'll pay a nice dividend. However, we won't pay all of our dividend. And the reason is you don't have nice years every year. And what we're going to do is pay enough of a dividend this year to make everyone feel, you know, happy and warm. But we're also going to keep some funds in the company because we reckon that next year or a couple of years' time, we mightn't have a good year. And so we'd like to be able to still be able to make some kind of a reward to our shareholders to keep optimism up at a time when everyone else is feeling pessimistic. And so the strategy in terms of dividend policy often will put dividends and all these other forms of distribution a little tiny bit out of step with the actual operations of the company. In the really, really good times, the company will tend to not distribute everything. And in the really, really bad times, the company will be looking for its undistributed previous earnings to continue to pay out a dividend to its shareholders. Not that the dividend is maybe coming from that current year, but in a sense it's just paid out of retained earnings in order to maintain morale amongst the market and particularly their shareholders. And so the psychology of keeping the shareholders kind of happy and stable is an important element in the financial management of a company. Okay, let's look at some of the considerations. Really, that's just a recap of what we started with. There's a practical side, which is important, that the company's dividend policy is a very important aspect of allowing the company to continue to make the investments necessary for the company to move, if you like, in the direction that it needs to maintain its market share or preferably to grow it, to develop new products and whatnot. And so if you pay dividends excessively, then you're going to weaken the capital reserves in the company, and therefore the long-term prospects for the company may not be so good. And remember, right in our first week or two, we talked about the object of the firm was to maximize the shareholders' wealth. Well, that is a long-term goal. It's not simply next year's profit. And so here with the dividend policy, we might be choosing not to distribute a dividend today because we're thinking of the long-term object of maximizing the shareholders' wealth. And that might be done better by portraying the profile of the company as something being solid, being able to pay a dividend year in, year out. The dividend may not be top shelf. In the good years, the dividend will be low, but the investors can go away feeling comfortable because the shares are appreciating in value regardless. And in the bad years, the dividend will still be kind of dribbling out, even though the share price might be looking a lot more stagnant. Okay, here are some of the questions. And I guess we've already gone over most of these. A lot has to do with the management's opinion, their belief about the long-term situation of the company. What's its long-term requirements for capital, for expansion? What's the long-term prospects for income production and so on? It's easy to talk about these things, you know, in theory, but one way or another, the managers have to actually take a punt on this. And it makes this aspect of financial management more than a little bit like a gamble, because the managers really have to be taking a long-term view. They have to polish up their crystal ball and say, well, this is a good year. It's not going to happen. I expect in a few years' time we're going to have a bad year. I've got to be prepared for that. But in the long term, the government's, the company is going to need to grow at a particular rate. So I need to be able to have that prudently provided for. And so these are the kind of issues, and I'll let you read through those in your own time. Okay. Hang on. We're basically just getting to a couple of examples now on the maths behind the dividend payment. What's happening there? Sakura is currently has 30,000 shares outstanding. Each share has a market value of $20. The company pays $5 per share in dividends. What will the value of each share be after the dividend payment? We can ignore tax. Okay. It should be, you should be able to kind of work that out pretty much seat of the pants. Okay, let's go and do it maths wise. The current market value is $20. Company is going to pay $5 per share. I think the answer is that once the dividend is paid, there's going to be $5 less per share in the company, and so the value is going to reduce down to $15. Let's look at the maths. We start off with 30,000 shares at $20 each, so we've got paid up capital of $600,000. They're going to be paying out 30,000 shares at $5 each. That's $150,000 in dividend payments. What's going to be left in the company? Simply 600,000 minus 150, which means that there's 450. And if we divide the 450 by the number of shares that are available, 450 divided by 30,000 is $15 per share. Okay, like that's a longhand way of, you know, illustrating what's going on there. A similar thing will happen with share repurchase. One of the things that's kind of curious about share repurchase is that because every dollar that goes out of the company in the act of repurchasing the share basically is making the company smaller. And so the shares that are left in the company are covering a small number of shares, and they're covering a small amount of capital. Let's look at how that works. Same situation, we've got 30,000 by 20. We've got now 150 shares at $20 being repurchased, so that's 7,500 coming back. The value of all the shares after repurchase, 600 versus minus 150, so that leaves 450. And now, what's the share price? Well, it's still the $450,000 worth of capital, but now it's been divided by not 30,000, but 30,000 divided minus 7,500. So it's only 22,500. And by the time we divide the 450 by the 22,500, we come out with the $20 per share. Now that really illustrates, we'll just go back to the previous example. It really illustrates the difference, if you like, between the two. And if you go through and you just look at how each person is affected by that, we can do a similar thing and sort of see that there's sort of equity left there. Okay, this is a useful slide. It basically illustrates how the franking credit works. We had that slide earlier on where we looked at the way that the $100 kind of filters down, and eventually the shareholder still pays their $45 or 45 cents in the dollar total tax. Here we're simply illustrating how the franking works. So here is a situation where we've got a dividend of 50 cents per share, and we've got a tax rate of 30 cents. We can work out what the franking credit is going to be. So this is the credit that goes to the recipients of the dividends. The the franking credit, in other words, as a recipient of a dividend, I'm going to get this credit against my next tax obligation. And so the 50 cents of dividend that I receive as a check carries with it 21 cents worth of franking credit. So it's basically prepaid 21 cents worth of tax. The maths of this, I think, is worth everybody playing with yourself. I can illustrate this until the cows come home, but it won't have the same effect until you actually juggle it around yourself. And if it makes total sense to you, then don't worry about this. Go off and, have a coffee or go for a walk or something. You don't need it. But getting your head around this very simple maths is useful. And my experience has been that when you do it yourself, when you actually sort of sit down with a piece of paper or maybe a calculator or what have you, it becomes a lot more evident. What's going to happen to somebody in this situation? They get 50 cent money coming as a check. They have the promise, or if you like, the benefit of having a claim against their tax of 21 cents. What does that mean when they come to pay their tax bill? What's the real advantage? Okay, I think if you go through the maths on this, you'll see that it basically balances out that what you've really got is an effective grossing up, if you like, of your apparent dividend, which is exactly in proportion to your ultimate tax obligation. So here, what's really happened is I've got 50 cents worth of money. I've got 21 cents worth of imputed dividend, franking credit. So that means I've really got a financial benefit of 71 cents. So overall, the impact that I expect to have on the company is what's left in terms of value in the company after the dividend's been paid. Now, the dividend being paid of 50 cents, the company has also paid tax of 21 cents, so the company has actually lost the 71 cents of value out of the company. And so if the company has lost that value, in the same way as if it had, simply lost the money or what have you, the effect on the share price, if the share price started off as $22.50, then by the time you take off this total value of the dividend, including its franking credits, the value of the company has now fallen to $21.79. Okay, if you think through that, it should make kind of obvious in a sense that everyone's getting fairly treated. That's really the object with that. I find working through these is useful. Also go through the examples in the textbook and the discussion in the textbook. This is very much like the politics of the way that companies work. So it's good to just reflect on it. Don't expect to understand it all the first pass. to a certain extent, the ideas are pretty straightforward and common sense when you can sort of see them. But at first presentation, often they appear a bit, obscure, especially this franking credit. Not that a lot of us will have to do too much with franking credits ourselves unless we're tax advisors. Okay, I think the slide set finishes with some links that are worth going off and having a look at. And I would recommend that you duck into those, especially those of you who are interested in this topic. Okay, with that, I think I'll stop the share. And I think that's about as much as far as we need to go today. Anyone have any questions or anything else? Everyone should have their assignment 1 results back. I'm going to be still expecting resubmission from some people from assignment 1. That must be done through SurveyMonkey, or it won't be accepted. And aim to have that in by Friday evening. So that's the only administrative stuff that we need to do. Any questions about today or anything else?
Sorry, sir.
Yes.
What will we do next week?
Next week will be questions and answers. And so what I'd like you all to be doing is starting your revision now. I mean, obviously, like, read over the materials for this week, but start revision. Look in on the exam questions that have been circulated. I think it's probably timely for you to be starting to spend time giving thought to how you're going to answer those questions. And if there are, issues or questions that come up from them, they'd be good to talk about next week.
Okay, thank you.
Great. Anything else? Okay, thanks for coming along today. I think I'll stop the recording.